Friends, welcome to FIN-TRAINICA channel, Finance and Investing Tidbits series. The theme of this video is what is the impact of fiscal deficit on government bond yields and prices. Welcome to this video. What do we mean by fiscal deficit? Fiscal deficit is the excess of government expenditure over government revenue. So when the expenditure is more than the revenue, the government gets into a deficit. In a developing country like India, with a lot of catch-up to do in terms of infrastructure and public services, fiscal deficit is naturally expected, though the central government's intent is to keep it as low as 3.5%. Challenges like subprime crisis or COVID-19 did prompt the government to go soft on these targets and allow them to go up. During the COVID-19 period, it went up beyond 9%. Those are exceptional situations, and large fiscal deficit during these periods is understandable and quite often necessary. In the normal course, however, large fiscal deficit becomes a challenge because fiscal deficit has to be financed by government borrowings or has to be monetized. Now, monetization, which is issuance of notes or money, is inflationary, and therefore that is not something which is often done. Instead, fiscal deficit has to be financed out of borrowings. So the central government borrows money, and typically banks, insurance companies, mutual funds which invest in government securities or gilt securities tend to invest in the government bonds. Now, when the government has to borrow aggressively, it would naturally increase the supply of the government paper in the market. And when that happens, the expectation of people, the institutions, the banks, the insurance companies who are going to invest in these government securities, their expectation goes up. The logic for the same is simple. When someone borrows more, the risk goes up. Interest rate expectation would also go up to that extent. Bond yields are nothing else but the interest rate expectation of the market, and thus they would go up too. Larger the supply, the lower will tend to be the prices. As we know, more the demand, the prices tend to go up. More the supply, lower will be the prices. Thus, on one hand, the supply causes the interest rate requirement of the market, which is the bond yield, to go up, and on the other hand, the supply also causes the prices to fall. Thus, we see an inverse relationship between bond yields and prices. Friends, if you have liked the video, please feel free to share with others.